Hello, Super Saver. I hope you're having a great week. So, I-bonds versus TIPS, Treasury Inflation Protected Securities in 2023. That's what I'll be covering in today's video. And specifically, here are the 3 questions I'll be answering. Why TIPS might be a better investment than I-bonds for some folks right now. Why, for others, I-bonds may still be the inflation protection winner. And how to figure out whether I-bonds or TIPS might work better for you. The vast majority of super savers on this channel are already familiar with I-bonds. I-bonds protect our principal investment against inflation via the I-bond interest rate, which is inflation adjusted semi-annually in May and November. Treasury inflation protected securities also protect our principal investment against inflation when held to maturity. But instead of doing this via the interest rate, which stays the same during the life of the TIPS, it's the TIPS principal amount that gets inflation adjusted. This TIPS 101 video walks through a detailed example of how this principal adjustment and interest calculation work. I've linked it in the description below for you. So, to understand why TIPS might be a better investment than I-bonds for some folks right now, we first have to understand the term real yield to maturity. The easiest way to explain real yield to maturity, given all the I-bonders we have in the community, is to go back to the I-bond formula. Remember, the annualized I-bond rate is made up of 3 components. Component 1 is the fixed rate. Component 2 is the variable rate, the semi-annual inflation rate, times 2. And component 3, this here, let's call it the bump. And no, bump is not a technical Treasury Direct term. It's a Jennifer Lammer term because that's basically what it is, a little bump in your I-bond return if you buy them during a positive fixed rate period like the one we're currently in. For the purposes of explaining what the real yield to maturity means though, I'm going to ignore this little bump because it simplifies the explanation and also because this little bump is generally speaking pretty little in the grand scheme of things. Working backwards to component 2, you'll see why I'm working backwards in a moment. Working backwards, component 2 here makes sure that our I-bonds keep pace with inflation. No more, no less. That is, after all, what I-bonds were designed to do, to keep pace with inflation, not to make us rich. Now, component 1, this fixed rate of 0.40% here. This component, it also doesn't make us rich, but it does help these I-bonds stay a tiny bit ahead of inflation by this fixed rate amount of 0.40%. Meaning, no matter how fast or slow the rate of inflation is increasing, these I-bonds will always earn 0.40% above that rate of inflation. And that's what the real yield to maturity is, the return on a fixed income investment above and beyond the rate of inflation. So for an I-bond, the real yield to maturity is essentially the fixed rate. And yes, this does mean that those of us who bought our I-bonds between May 1st, 2020 and October 31st, 2022, we're basically holding I-bonds with a real yield to maturity of 0% because, well, our I-bonds have a fixed rate of 0%. With those 0% fixed rate I-bonds, we'll always keep pace with inflation, but we'll never beat inflation. Whereas the folks who bought I-bonds on or after November 1st, 2022, they'll always stay a tiny bit ahead of inflation by that 0.40% fixed rate amount. And for those of you who already have the
"But Jennifer, after taxes, I'm still not keeping pace with inflation"
argument in your head, fair enough point, but that's a different conversation for a different day. For this conversation though, there is one important side note about real yield to maturity that I'd like to point out, given all the super savers in our community who own or are interested in owning bonds as part of their portfolio. Bonds are typically quoted on a nominal yield to maturity basis, not on a real yield to maturity basis. Meaning that if you hear something along the lines of the 52-week T-bill is yielding 4.7% right now, that 4.7% is the nominal yield. To get to the real yield, we would need to take the nominal yield and subtract out the inflation rate. So a nominal yield of 4.7% minus, let's use the number from the latest CPIU release, so minus an inflation rate of 6.5%, means that the real yield on that 52-week T-bill is actually negative 1.8%. With I-bonds and TIPS, the inflation element is already accounted for, either via the variable interest rate for I-bonds or the principal adjustment for TIPS. And as we've already shown, for I-bonds, the real yield to maturity is basically the fixed rate, the return that is above and beyond the rate of inflation. Now, let's move on to what the real yield to maturity on TIPS is right now. The answer is the real yield to maturity on TIPS right now is higher than the current 0.40% fixed rate on I-bonds. The U.S. Department of the Treasury tracks this information here daily for every market trading day. And if we scroll down, we can see that the current real yield on TIPS of different maturities are all higher than the real yield equivalent for I-bonds, the 0.40% fixed rate that we talked about earlier. And yes, this drop in TIPS yield probably was to some degree impacted by the Federal Reserve's announcement of a 25 basis point rate hike. These yields have rebounded since then, though, as you can see here. This graph plotting the real yield on 10-year TIPS versus the real yield, the fixed rate on I-bonds, does bring this point home. The yellow line here shows the real yield on 10-year TIPS, and this blue line here shows the real yield on I-bonds, the I-bond fixed rate, over the same period. And as we can see, even though the real yield on 10-year TIPS has come down a bit recently due to moderating inflation and interest rate expectations, at current levels, at the time of this taping, the real yield on 10-year TIPS is still about 1% higher than where the real yield on I-bonds is right now. This I-bond fixed rate of 0.40% that I-bond buyers will get through the end of April 30th, 2023. In fact, over this 20-year period of data we pulled, generally speaking, and apart from a few exceptional periods, TIPS have offered a higher real yield to maturity than I-bonds. Which makes sense, really. It's the typical risk-return trade-off. TIPS provide a bit more return than I-bonds because, in a sense, they're a bit riskier than I-bonds because TIPS are publicly traded on the secondary market, meaning their price and yield will react and fluctuate more quickly and, in some cases, dramatically based on changing economic conditions and market expectations, as you can see from these peaks as well as troughs. Compare that to I-bonds, which cannot be publicly traded on the secondary market, and therefore, in this respect, are sheltered from the market's ups and downs. You know you won't lose your principal if you have to redeem your I-bonds early. You know the interest you're getting at any given point in time. So I-bonds are, in that sense, more stable than TIPS, and more stability, lower risk, generally goes hand in hand with a lower return. More on the stability and advantages of I-bonds over TIPS later when we talk about why I-bonds may still be the inflation protection winner for some folks. Right, so here's where the real yields on the 5-year, 10-year, and 30-year TIPS are trading at the time of this taping. As I mentioned earlier, that's about 1% higher than the real yield equivalent on I-bonds currently, the 0.40% I-bond fixed rate. So, advantage 1 for TIPS over I-bonds right now. The real yields are higher currently. That's what we just covered. Advantage 2 for TIPS over I-bonds. You can buy TIPS in maturities of 5 years, 10 years, or 30 years. I-bonds all have a maturity of 30 years, although you can redeem them after 5 years without penalty, without losing the last 3 months' interest. Advantage 3, the purchase limit for TIPS is high at $10 million per person or household per auction. Not really a constraint for most of us, unlike the lower I-bond limit of generally $10,000 per person per year. Advantage 4, TIPS are convenient to buy and sell. You can buy them via Treasury Direct, or you can buy and sell them via your bank or brokerage company, meaning you can buy tips in either a tax-advantaged retirement account or a normal taxable brokerage account. I-bonds are only available on the Treasury Direct website. Advantage 5. Tips are almost immediately liquid. If you hold your tips via your bank or broker, you can sell them as soon as you want in the secondary market if you need the cash, or simply if you don't want to hold them to maturity for whatever reason. If you hold your tips via Treasury Direct, there is a bit more of a wait time, as you do need to hang on to your tips for at least 45 days before you can transfer those tips to a bank or broker to sell. In contrast, I-bonds cannot be sold. They can't be redeemed under almost any circumstance within the first year after you purchase them. A word of warning on tips liquidity and secondary market transactions though, especially since this is so often pitched as a tips advantage. When you sell in the secondary market, you get whatever the market is willing to pay. And in an uncertain and still rising interest rate environment, the secondary market price that you'll get for your tips may come as a negative surprise. Because remember that at the end of the day, while tips offer inflation protection, they function like bonds. So when interest rates go up, prices of existing tips that were previously issued at a lower interest rate will go down. And I'll show you what I mean with a real-life example in the next section on why I-bonds may still be the inflation protection winner for some folks. Moving on to Advantage 6 that tips have over I-bonds. Interest on tips is paid in cash semi-annually, which may be important if you're a super saver who relies on a regular stream of interest income. This, of course, also means that you need to pay federal income taxes annually on that interest, because interest on tips, like interest on I-bonds, is exempt from state and local income taxes, but not from federal income taxes. In addition to the taxes due on the tips interest that's paid semi-annually, you'll also need to pay for any inflation-adjusted increases to your tips principal, even though you don't physically get your hands on that principal amount until you sell the bond or it reaches maturity. All manageable, but this so-called phantom income can complicate things during tax preparation time if you're holding your tips in a taxable brokerage account. So all these advantages that tips have over I-bonds as an inflation protection investment sounds almost like we should all be buying tips, right? That was a trick question. For those of you new to the channel, that was a trick question. Tips may not necessarily be the right choice for everyone, and here's why. The advantages of I-bonds over tips. Advantage 1, the value of your I-bonds stays stable. Let's take the $10,000 of I-bonds that I bought for myself in 2022 as an example. I know that every day when I wake up, go to work, and carry on with my life, that this principal amount is still $10,000. It won't change for as long as I hold this I-bond. And I know that this interest that I've earned so far will also stay the same this month, and that at the beginning of next month, another month's interest will be added on. Now, compare this to the tips in one of our brokerage accounts. This is what it's looked like for the past 2 years. That conversation where my husband told me he may have bought some tips from his broker a little while back. So how do these things work? Let's just say it wasn't one of our most amicable family dinner conversations. Luckily, I'm a long-term investing, hold-to-maturity kind of girl, and my husband shares this mindset. So we can continue to sleep at night knowing that if we hold these tips to maturity, we'll still get back our original investment or some inflation-adjusted version of it. And we do get some interest along the way as well. If we had to sell them though, because we needed the cash, or for whatever reason, we'd be in a bit of trouble, which brings me to advantage number 2 that I-bonds have over tips. 2, with I-bonds, you know exactly what you'll get, both when you buy them and if or when you want to redeem or sell them. Again, I know that this current value here in my Treasury Direct account, that's what I'll get if or when I have to redeem my I-bonds. Now, let's look back to those favorite tips of mine. This is the last price that's shown, about $117.63 per $100 par value. Well, I asked for a bid quote to sell these. Want to guess what price I would have gotten if I really had to sell these? $96.05 per $100 par value. A difference of more than $21 from the last quoted price of $117.63. So no thank you. Like I said earlier, now that we have these tips, we'll be holding on to them to maturity. Advantage 3, taxes are less complicated with I-bonds. There's no need to deal with taxes on phantom income from your inflation-adjusted principal every year, like there is with tips. And if you choose the default option of paying taxes on interest earned at redemption, you don't have to worry about taxes at all until your I-bonds mature or until you redeem them. Plus, if you qualify, you can avoid paying taxes altogether on your I-bonds if you use them to pay for higher education. There are restrictions that apply, so if you're interested in this, I've included the Treasury Direct link for this in the description below. Advantage 4, your I-bonds can serve as both an inflation-protected investment and as an emergency fund once you've held them for the minimum holding period of 12 months. I've already shown you how volatile TIPS prices can be, as well as the massive discount that could be applied if they need to be sold on the secondary market during uncertain times like these. And you know when many people need their emergency money most? During uncertain times like these. So TIPS, they would not function well as an emergency fund, given their potential price fluctuations and sometimes low bids. I-bonds, on the other hand, once you've held them for 12 months, are pretty much shielded from the ups and downs of secondary market forces and do hold the value that you'd expect them to hold. If your I-bonds show a value of $1,000 in your Treasury Direct account, you know that that's how much you can redeem them for if you ever have an emergency. If your TIPS show a value of $1,000 in your brokerage account, though, that's not necessarily the amount you'll get if you have to sell them overnight if you ever have an emergency. In fact, what you could get may even be significantly less, especially if other folks around you are also having emergencies and trying to sell at the same time, as they do during possible recessionary times. So moving on to advantage 5 that I-bonds have over TIPS. I-bonds are simple and easy to understand. Okay, maybe not the actual interest calculation formula initially, but now that I've dissected that for you here in this video, even the mystery of I-bond interest is no longer a mystery. With I-bonds, we know that if we put in $10,000, we earn interest on that $10,000. The interest rate changes every 6 months in May and November based on inflation. And when we redeem our $10,000 of I-bonds, we get back that $10,000 plus interest earned minus any applicable early withdrawal penalties. With TIPS, there's the real yield, the nominal interest rate, the inflation-adjusted principal, the market volatility, the bid-ask spread, and that's just what we've talked about today. Some of you may find this hard to believe, but I've only scratched the surface on TIPS in today's video. So, the choice of TIPS versus I-bonds is not straightforward. Both offer clear, distinct advantages over the other. Which one you choose really depends on a number of factors, including your age, risk-return profile, and understanding of how TIPS versus I-bonds work, just to name a few of these factors. So, with that in mind, let's talk a bit about how you can try to figure out where the I-bonds or TIPS might be better for you, and how I'm currently thinking about this. Let's frame this I-bonds versus TIPS decision based on age and runway to retirement, time to retirement, basically. Group 1 are those of you in your 20s, 30s, and 40s with a long runway to retirement, meaning you have a lot of working years ahead of you and don't plan on retiring for at least another, say, 10 or 15 years. Group 2 are those of you in your 40s, 50s, or older with a short runway to retirement, meaning you're planning on retiring in the next few years, or perhaps you're already in retirement. So, if I were in this group, if I were in my 20s, 30s, or 40s with a long runway to retirement, I would probably be focused more on dollar cost averaging into equity markets rather than concentrating on I-bonds or TIPS. Yes, equity markets are choppy right now. And no, we don't know if things have bottomed out yet. No one, at least no one that we know, can time the market. But What we do know is that in the long run, the return on the S&P 500 has historically outpaced the rate of inflation. So, if I were in my 20s, 30s, or 40s right now and not planning on retiring anytime soon, all other things being equal, I'd most likely be allocating the vast majority of my investment portfolio into the stock market. Now, I do think that there is a case at this age and life point for having a small percentage of your savings, not your investment money, but your savings money in I-bonds, if that savings is part of a longer term plan, say to buy a house in 3 to 5 years, or simply because you want to start that early with building an inflation protected fixed income portfolio for retirement. Because in this case, your I-bonds serve a dual purpose as inflation protection and also as an emergency fund. Do keep in mind though that you cannot withdraw your I-bond money at all in the first 12 months. And if you withdraw within the first 5 years, you will lose the last 3 months' interest as an early withdrawal penalty. But that last bit may be worth it if your goal is to build up a longer-term emergency fund that's inflation protected. Now, let's move on to group 2. So, if I were in my 40s, 50s, or older and planning on retiring in the next few years, or I'm already in retirement, here are the 3 questions I'd ask myself to see if I should be putting some tips into my portfolio for some higher yielding inflation protection. Question 1, do I need the principal on my TIPS investment back before maturity? Yes, TIPS are liquid and you can sell them in the secondary market. But as I've already shown you earlier in this video, in times of market uncertainty and expected future rate hikes, like the one we're currently in, if you do have to sell your TIPS before maturity, you may get significantly less than the price you paid for them. So, if you think there is a chance that you might need to sell your TIPS before maturity for whatever reason, it may be better to put that money into I-bonds or another safe investment that better guarantees the redemption value that you have in your mind. Of course, this may only work up to a certain amount given the restrictions on buying I-bonds. Question 2, am I still learning how I-bonds and T-bills, notes, and bonds work? Trying to figure them out basically. Think of TIPS as a cross between I-bonds and T-bills, notes, and bonds. TIPS have the inflation protection element of I-bonds, but they also behave like T-bills, notes, and bonds because of the fact that they are publicly tradable bonds. Just ask the folks from last year who saw the value of their existing TIPS plummet as interest rates rose. And in addition, TIPS have inflation indexing adjustments and pricing components that are unique to just them alone, which, as I mentioned earlier, we haven't even covered in today's video, and which can get quite complex. And that's before I bring up the taxes on the phantom income that I mentioned earlier. I'm a huge believer in understanding exactly what you're getting into when it comes to investing in your money. So if you're still learning about, or you're a bit unclear about how I-bonds, treasury bills, and the like really work, it's probably best to get a good, clear understanding of those fixed income investments before diving into TIPS. Question 3. Do I get emotional when my portfolio, my investments, have had a bad day in the market, or a bad week, or a bad month? I know some of you do because I see it in those comments and messages. So, if you hold your TIPS to maturity, you'll get the TIPS interest that you're supposed to get paid to you semi-annually. And at maturity, you'll also get your TIPS principal and any related inflation-adjusted increases in that principal paid to you as well. But in between when you buy your TIPS and when those TIPS mature, there'll be a lot of good and bad days in the market. Remember that the value of your TIPS, regardless of whether you hold them in a tax-advantaged retirement account or normal taxable brokerage account, are marked to market, meaning the prices will fluctuate with market ups and downs. So, if you're not good at emotionally distancing yourself from your investments on a bad market day, week, or month, then TIPS are also probably not for you. Now, if you've gone through all 3 of these questions and answered no to all of them, and these TIPS advantages seem appealing to you, then it's likely that you should explore tips further as a higher yielding inflation protection instrument. And if this is you and you think I should do more tips videos, then drop a comment below and let me know. Right. So what I've just done is give you a framework that will hopefully help guide you through this tips versus iBond decision-making process. But as I always say, everyone's financial journey is different. I actually fall into group 1, in my 40s, with no immediate plans for retirement and quite a bit of iBonds, which now double as inflation protection and as an emergency fund. So in theory, I shouldn't be thinking about tips. And I actually haven't bought any tips. Well, now I know we own tips thanks to my husband, but so far this year, we haven't bought any tips or iBonds yet for 2 primary reasons. First, I'm still in the middle of wrapping up my iBond analysis for myself and for the next iBond video, so stay tuned for that one. And second, I'm trying to decide how much of our portfolio to allocate to fixed income if or when longer-term Treasury note yields go higher. So for now, our cash is sitting in shorter-term Treasury ladders, which is fine for now, given the rates and liquidity. But who knows, right? Despite the usual ups and downs in the short run, tips have definitely become a lot more attractive recently compared to where they were just 2 years ago. And if the real yield on tips picks up and starts moving north again, it's definitely something I'll be seriously considering. I'm definitely watching the tip space closely, so keep watching along with me if this is something you're also interested in for yourself. For now, be sure to check out this tips playlist here if you're interested in learning some more tips basics. If you've already seen those 2 videos and want a deeper dive, then drop a comment below and let me know. All right, Super Saver, as always, if you enjoyed this video and learned something new, don't forget to share it with those you care about, and of course, hit that thumbs up, and see you again very soon with another brand new wealth building video.